It's long been a saying in the Bitcoin community, short the bankers, long Bitcoin. Now, that was a bit of a meme for a very long time. Pomp used to tweet about it all the time, but maybe for the first time in history, of course, on my 1 week that I decided to take off when the entire world exploded. Well, as of last Monday, if you shorted the banks and longed Bitcoin, well, you were a genius and probably are already retired on a yacht somewhere in the Caribbean. Is this a real trend? Was this a coincidence? Is this noise? Is there no signal? As usual, we have a ton to unpack, and it's Macro Monday. I've got my favorites, Mike McGlone and Dave Weisberger, joining. Frankly, I missed a lot this week, and just like you guys, I'm looking for them to catch us up. You guys definitely do not want to miss this today. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of Wall Street. Before we get started, please subscribe to the channel and hit that like button. Yes, I had a week off, although I think that I got more gray hair, and I'm probably going to end up with Mike's haircut by the end if things keep going this way. I was trying to keep up, do a Twitter Spaces with spotty internet, but no newsletter and no YouTube for a week. You know, there's that old saying that I don't remember exactly what it is, but basically that you know, time can pass a full decade, but then you can have a decade in a week. Feels like we had about a decade's worth of news and events in a week. A lot of things that people were theoretically saying could happen, and you would have said those crazy Bitcoiners don't know what they're talking about. Banks won't start collapsing. We've learned all of our lessons from 2008. Clearly not the case. I'm going to go ahead and bring them on right now instead of wasting my breath. Gentlemen, how are you today?
Hello.
Hey, Scott. Doing great.
Dave, yeah, you and I chatted briefly even yesterday, and you said, man, I'm really looking forward to tomorrow because we have a lot to talk about. We couldn't have missed a worse week, I think, last Monday. Probably it was that's going to be one of those goes down in history sort of days in markets that started this crazy week. Maybe we should just set the stage here, right? I mean, banks obviously in a lot of trouble. Should be no surprise to anyone who understands fractional reserve banking when lizard brain humans all start to withdraw at once. But I think the bigger story is that Bitcoin actually kind of did what it's supposed to. So either of you, feel free to just give me some context. What are you thinking right now after processing everything that's happened this week? Dave, you want to go ahead?
Yeah, I mean, look, there are certain iron rules, you know, supply and demand, etc. There's one other iron rule that I've always believed in. Hayek believes in it. Milton Friedman believes in it. A lot of other people, that inflation is a monetary phenomena, except for what people miss, what they missed. Well, Hayek didn't really miss it because he talked about the crack up boom, but a lot of people ignore the fact that there's two types of inflation. There's asset inflation and there's consumer inflation. You all have heard me say this many, many times. So given a choice, what the powers that be would have happen is asset inflation is a good thing there in their opinion, and consumer inflation is a bad thing. So what did we have? We had a situation where consumer inflation started to rampage higher. We've talked about the whys, doesn't really matter. And the Fed decides to start hiking interest rates as, I don't want to say steal Mike's words, but I paraphrase Mike all the time, in a historic manner. And essentially, the great sucking sound we all heard during all of 2022 is liquidity being sucked out of the system. But what was interesting is the liquidity that was being sucked out of the system was the money being pushed to the sidelines because people couldn't afford the cost of capital. And the Fed no longer increasing the size of their balance sheet. And God forbid they let it tighten a little bit. Well, what have we seen over the last week, and what do I expect to continue, is it is not the same war. So everybody wants to always fight the past war, look at the past thing. I think the Fed is in a rock and a hard place. You've all heard me say this for years. I think they've been trapped. So what do I think Powell's going to do? What do I think he needs to do? And I don't think there's a good answer. This is the, for those geeks in Star Trek lore, this is a Kobayashi Maru scenario that I don't think he gets to reprogram the simulation. But what's his best attempt? His best attempt is flood the banking market with liquidity to preserve what's going on there, at the same time as not signaling defeat. If Powell doesn't raise rates, the market sentiment will be, oh my God, he thinks everything is going totally to hell and the Fed liquidity isn't going to solve it. I don't think he wants to do that. That's why I believe he will hike rates and be much more non-committal than people think about pausing. At the same time, the BTFP, which we'll talk about in a bit, which is the lending facility they just put in place, has the potential to be a $4 trillion of quantitative easing. And that's only the Fed. If you listen to Arthur Hayes, who wrote another brilliant diatribe last weekend? I can't remember. It was recently. His point is all the other central banks are going to have to do the same thing. So you have a potential torrent of liquidity to back up banks out there. Yet we have lots of plumbing broken. So, I don't want to go through everything. I'd like to hear Mike's opinion, but like plumbings that are broken when Credit Suisse gets bought by UBS, which has happened since the last week that you missed, the other way around, UBS buying Credit Suisse, of course. There's
buying them with a little bit of a backstop from the Swiss.
Just a little bit at an 85% discount to where it was trading on Friday and wiping out the enormous number of bondholders and various other instruments is a very big deal. And there's a lot of other banks with those same sort of bonds. And now the bondholders think they're going to get wiped out. And so that is, there are lots of cross currents going on here is sort of the point. Okay, let me stop now because we have a lot.
Yeah, have at it, Mike. Godspeed, my friend.
Well, it was a good start. First of all, I'm jealous of your background, Dave. And I have to thank Scott for the first thing you said is you just solved my dilemma I've been working on since last night. Mike, I've got to publish on what's going on with fully reserved crypto dollars and Bitcoin versus banks. That's like the headline. I was trying to find the right charts. When I publish, I'm like, okay, one chart sells the story. And when you said that, I just overlaid the KBW bank index with Bitcoin. I'm like, there you go. So thank you, Scott. If there's a way I could thank you for that. And that's going to be what I'll publish tomorrow if I get to, time to finish writing about it today. But to me, I think it's also what's got to go to the Fed. Is what I watched the on Turner Classic movie last night, the movie Rare Window by Hitchcock. Some of us, it's just a classic human nature story and everything. And that's, to me, it just hit me. That's what the Fed's doing, and ECB. They're classic academics. Intellectual views, what the ECB did last week, when the Fed might do this week by tightening, and they're missing the fact that the forward-looking indicators for deflation, they're not falling, they're collapsing. This is a higher housing market is turned over at a higher velocity than it did in 2006-07. Commodities are collapsing at about the same pace. The Fed was easing back then. And I look at this as, okay, this is a 1929-ish type scenarios. The next significant move we should see from the Fed as futures are pricing in is easing. And I just love that narrative that everybody expresses, oh, if they stop tightening now, excuse me, markets are collapsing. And I like to look at the headline from my colleague in Tom Orlick that says, you can't be a hawk in a bank run. And I look at it as, okay, so for what minor potential small probability should this be just a one-off? It was a year ago the Fed started the most aggressive rate hike schedule ever. We've had this war, we've had the big pump and collapse in commodities, we've had the collapse of mortgage refinancing, we're seeing the collapse of the price of new homes for sale divided by sales. This stuff is historic. Money supply, the fact that I can say in the US it's negative for the first time in history after being the most ever just a few years ago is just historic. So I think we have to look at that in that context in the macro. And I like I said, we have our 8:30 meeting with our strategist, and Gina Martin Adams is our equity strategist. She's been spot on, and her quote this morning was, equities are going to be remarkably disappointed if the Fed does not pivot this week, or at least signal a pivot. And the key thing, remember, is we had a triple witch expiration last week. A rule Dave and all of us have learned trading options, particularly when you're bearish puts, is markets go down after my puts expire. That's just the way it's always worked. And yeah, I know you'd laugh because that's why I don't trade anymore, man, because I would be right. And then my puts expire and the market dropped right through my strike and oh shoot. So to me, that's what's potentially at risk this week. And I still worried about that ebbing tide of the stock market pulling down Bitcoin. But we have to admit what's happening here with this fully reserved crypto dollars and things like USDC that just backed up almost to full extent that had exposed to a bank. And then everybody realized, wow, they're fully collateralized. These banks aren't. This is revolution. I think this is that paradigm shift that we've been waiting for. Bitcoin is, outperforming Ethereum for a reason. I mean, it's becoming global digital collateral in the world that way. Yes, I was bearish initially around 25, but it's showing that divergent strength. We tested it, and now it's proving. Now, I'm not saying it's not going to be pressured lower, but to me, this is that shift lower. And I'll end on what's happening with things like crude oil. I did enjoy some of the simplistic comments you got last year from people who analyze supply and demand and didn't realize it doesn't matter anymore. It really doesn't. When the world's collapsing, the most significant thing for commodities to always remember is they're the most autocorrelated assets on the planet. When they go up too much, they push themselves lower, their own worst enemies. Now we're at the stage where they're probably going to help create the rebalance in supply and demand, but it's nowhere near that. You have to have a significant period of very low prices for that to happen, for consumers to come back, for that supply to get squashed and the demand come back. It's real early days. So I look at this as it's only March, and the best performing commodity so far this year is gold, up 9%. What stops that?
Can we say that the best performing commodity is Bitcoin?
Yes,
fair?
well, it's from a traditional commodity standpoint in something like the Bloomberg Commodity Index. But I'm glad you pushed back. You made that comment because it's not a pushback. It's a good point. We were writing about this last year. People talking about a commodity supercycle. My gosh, I've just seen so many people lose their jobs and careers trying to play for that. A decade ago, when I was in that business, I just didn't want to see the young people do it again. And I've seen some of it again last year. Oh, this commodity supercycle. Like, it's happening in Bitcoin.
Yeah, I mean, I would make 2 points, Scott. First, this is completely unprovable, so it's easy for me to be a pundit on this one. But if Bitcoin didn't exist, I think gold would be at 2,500 this morning.
Yeah.
And the reason I say that is I think that Bitcoin has taken on the margin a fairly sizable percentage of people who were speculating on gold as the hedge towards real monetary debasement. And so I believe that we've seen a lot of this. I mean, 2022, you saw gold being resilient on the way down, didn't really fall anywhere near as much as you would have expected during this tightening cycle. It's because people don't really believe in global central banks, and there's a lot of things that have been lost. But the absolute reality is gold is also a commodity, and its inputs prices went up also. So, you have that small thing. The fact is when Paul Tudor Jones made his fastest horse comment a few years ago, that heralded in a rush of a lot of people who, on the margin, decided Bitcoin was a better way of making that same bet. So gold is up. Okay, that makes sense for a bunch of reasons. But the reason it's not been anything crazy, and it certainly hasn't maintained purchasing power parity like it used to, is because of Bitcoin on the margin. So that's the first point, to what you said. The second point is, let's be fair here. What's causing this problem? And there's going to be lots of recriminations and lots of interesting deconstruction. But at its core, you had trillions of dollars of U.S. and other bonds bought at sub 2% interest rates. And those trillions of dollars were allowed to sit on balance sheets of financial institutions with absolutely no loss. If you bought a bond for 100 and it's now marked at 67, instead of reporting $33 in losses on that bond, you report zero because you say, I'm going to hold it to maturity. And so the other thing that I am absolutely sickened by the absolute temerity and cheekiness of various senators who claim we need to investigate what happened when they know full well what happened. They knew there was a cancerous rot on the balance sheets of banks that, as long as depositors left their money in the system, the system would be okay. So to be blunt, I think that once, people, when you look back at what was, if this in fact rages out of control, like the Chicago fire, Mrs. O'Leary's cow was not even.
I got to push back on that one, but I'll mess with you a little bit. Well, my uncle Ed Burke, who's a politician in Chicago, proved that was not O'Leary's. That was a push against the Irish at the time, but that's okay. Nothing to do with my name.
Well, whatever. Well, you're saying,
with that one.
in honor of last Friday, I won't say like Mrs. O'Leary's cow, but like whatever it was.
Can't prove it.
In this case, it's easy to prove. When
Yeah.
Elizabeth Warren and her colleagues attacked Silvergate Bank, sparking people to pull the money out, which they then folded. You then had everyone raised their heads up and said, okay, there's an issue. They have this problem on their balance sheet. So when the next day Silicon Valley Bank announced they had similar problems, people forgot everything else. It was like, oh, well, had the Silvergate not happened, I mean, look, once again, can't prove this, but understanding human nature, as you said, Scott, had Silvergate not happened, when SVB said we had a $1.8 billion loss, but we can raise $2.5 billion in capital, they probably would have been able to. The fact that another bank that was in the tech sector had just seen a run caused everyone to go, uh-oh, and boom. And this is the classic example of if you're in military strategy in the old days, the stupidest thing that nobody ever did if you were battling in a forest was light a forest fire. The wind might be shifting toward your enemies, but understand that wind can shift. And that is literally what happened here. And so, yes, I'm being vitriolic about Senator Warren. The last thing you got to do is yell fire in a crowded movie theater. Now, I think it's much more, I'm kind of probably a little bit calmer and softer than Nick Carter might be. But he's on the right branch. We're certainly not far apart in terms of conspiracy theories. But I think it's really important to understand mob psychology. Once you start it, you need to stop it. And I think that's why the Fed effectively pulled out a bazooka by saying all bank deposits are now covered, period.
Right, well, let's go ahead, Mike, please.
And they're still expected to raise rates this week. Like,
yeah,
oh my God.
That's where I was going to go. But I want to unpack even a bit more the sort of endless bazooka that you just talked about. That works at 3 banks. Maybe it works at 4 banks. Maybe it even works at 5 to 10 banks. But I mean, First Republic had $70 billion worth of withdrawals, 40% of the holdings in the entire bank. They're done.
Well,
right?
First one point, Scott. First Republic is very unique. Of most of the banks that have the cancerous rot in their balance sheet, I mean, cancerous rot. I mean, we're basically saying
that was the system they were forced into. I mean,
that's right. I'm not blaming
all to do with your balance sheet, but yes.
But I want to make a point because I read this morning. I think it's really important to understand. I think it was Noelle who pointed it out on her Crypto is Macro newsletter. It might have been her or somebody else, but First Republic had a disproportionate amount of their bad debt or their bonds that are underwater in munis, which are not part of the Fed program.
Right.
Municipal bonds, which is fascinating. So that would explain why the Fed has gone to such extraordinary measures to help coordinate a private bailout of First Republic. Because if they don't, then the only thing they can do is expand the BFTP to cover municipals, which is a very slippery slope that they don't want to go down because there's that makes it even bigger than it was. And so that's why they're doing it. And it's fascinating to watch this play out because I'm sure if Powell were watching or listening to me now, he would be cursing under his breath saying, why the hell are you telling people this? Seriously.
Well, the key thing,
go ahead, Mike.
Key thing also take away from what you said, Dave, is we're talking about trees. It's the force that matters. These are the force is overwhelming that, okay, so I'm getting nothing at my bank. I can get 4.75% in a 1-year bill. Sold. It's just in the 2-year note. Jim Bianco pointed that the inflection point was in 2-year note went to 5%. And we said, what boomer on this planet is not, and maybe involved with boomer rocks, is not buying 2-year notes. But to me is the key thing here is this is the macro ebbing tide just getting started. At this stage, prudent central banks are supposed to say, we see significant deflationary forces developing with banks, commodities, you name it, mortgage, housing, everything, stock market going lower, and we're prepared to help stop it from becoming a significant global depression. They're doing the opposite. And right. I know what I got to, and then one key thing, quote, years later, this is about the Chicago fire. A man named Louis M. Cohn confessed to starting the fire by accidentally knocking over a lantern while running away from an illegal card game. When you're from Chicago and you heard how Catherine and Patrick O'Leary's car knocked over, I have a sister named Catherine and a son named Patrick. Us Irish, we get tweaked. But I had to bring that out because I'm just an American mutt. So
that's so funny. But look, the other point I want to make here is but Powell's not an idiot, and he knows that if the banks all take them up. I mean, the last 2 weeks we've seen the biggest use of expansion of the Fed balance sheet since the GFC. I mean, in the repo facility, it was huge. I mean, you should pull that one up. I'd love to see that because I know you have that data. But the truth is, if he's going to basically expand his program to all these banks, if Europe is going to do the same, I think he looks at the slight rise in interest rates as sort of a token to, quote, sterilize all the liquidity he's literally about to inject or is in the process of injecting into the system. I'm not saying it's the right thing to do, Mike. I want to be really clear. Yeah, look at that. So you tell me that he doesn't look at that and say, uh-oh, I know what happened. I can't afford to have inflation go crazy. I can't stand another bad inflation print. Now, once again, not saying that's what I would do. I'm merely saying I strongly suspect that's what he feels he has to do. I could be wrong.
Yeah, some of the other charts, this is the one I just happened to pull up while you were saying it, but I've seen somewhere actually the 2023 number dwarfs that 2009, but here it looks like it's already about equivalent. But basically, I saw that within the first 2 or 3 days of last week, they effectively erased 60 or 70% of the quantitative tightening of the previous year.
Yeah, the key thing our economists point out is what you're seeing right now is temporary. QE is permanent. That's permanent. So the question is temporary. How temporary is it? And as you know, my views is this is early days. So I think the issue is how does this man pivot when he speaks? And I would say, well, maybe he should just say, well, in July, producer price in next year of year is going to be deflationary negative. Why? Because Mike McGlone told me it's simple math. It's just it's just how it's going to work because of an index measuring index when commodities collapse. PPI's 80% quarterly to CPI, and this time next year we're going to be talking about how much more they can ease, and we might be done with that because they're can't go below zero. This is that bad. I mean, why is I guess it's one of the things I remember being in the trading pits. We always just kid around. We need someone who's runs money like Dave or who's an ex-hedge fund guy on the board of FOMC to point out, no, you can't just be a bunch of intellectual academics when you're running the world's largest economy. You have to be looking forward. And to me, that's the big miss that's happening. This is that 1929-ish thing I published a little bit about last year and got a lot of pushback on. What's
You've been talking about that every single week on this show. You've said that every single week here. Yeah.
Well, here's the key thing is about what I'm supposed to do is, they call me McGlone. I had some of that, but if I see a hurricane coming and I don't warn people, it makes me very irresponsible. This is a hurricane, and everybody I know said you need to protect yourselves. And there's nothing wrong with buying. I can't rank recommendations, but when you see treasuries and they're giving you almost 10% over 2 years, you're supposed to say that's just what you're supposed to do and let the rest of the world try to make money in the stock market that is way overdue for a peak to trough 50% correction. When would it be corrected? Maybe less than 20%.
So I'm going to say it ain't going to happen. And I use that word because specifically, and the reason is because they can't afford it. So I'm going to make 3 points. First, I want to quote the Gipper. There's nothing so permanent as a temporary government program. And just anyone who really believes this is a one-off, I'm going to back up the banks today, but tomorrow it'll be okay. I don't think so. The reality is what they need to do and what they will do are two different things. We'll get back to that in a heartbeat. The second is in the middle of what you just said, you had a little paraphrase there, which I think is a Freudian slip, but it's very true and it can't work. The fact is the Fed does believe they are running the economy, but the fact is no central place could ever run an economy, much less the economy of the world, which the Federal Reserve is really at the vanguard of. So it's going to be, excuse my language, but fucked up if you try to centrally plan and manage an economy. And they are trying to do that with too many things. But the thing I wanted to get back to is what they need to do, or what they want to do, are maybe very different. What they need to do is keep the long end of the curve low, which is what they've been doing, which, by the way, heartily explains why it is that they allowed banks throughout the entire system to take long duration risk. Why? Because they wanted them to own the long end because it kept funding costs lower.
Right.
So why do you, I mean, if you think it's not intentional that the accounting rules are written the way they are, that wasn't lobbied by the banks, well, trust me, as someone who spent a lot of years at Citigroup, I know that their lobbyists are working with all the bank lobbyists to make rules that are more friendly to what they're doing. And if they're being pushed to buy long term, they wanted that accounting treatment. But now we have it, and we have significant holes in the system. If they just patched the hole and assumed it wouldn't take on water again, yeah, that would be the best thing to do. But they're unlikely not to do it. What they're much more likely to do is to reliquefy the asset economy and hope that the real economy cools for a bit, and then in some period of time before the election cycle, like so the next 6 months, then reflate the economy. The problem is the asset markets can see that. And so if you're as saying it as strongly as you are, Mike, then assets are going to basically say, well, they're going to have to reliquefy. If they reliquefy, the money's coming to us this time, like it did before 2020, because in every other previous, liquefaction cycle, it went much more to assets, which is why we have the wealth inequality that we have today. So I think that it's hard to see risk assets getting too badly destroyed when the Fed is likely to liquefy. Now, if they get really dumb and say, well, this is temporary, we're going to limit the system, and by the way, we're going to keep hiking rates until we see inflation, below 4% or some number like that, then I think you're right. Then 50% retracement will look like a garden party. I mean, it could be as bad as the back half of the 70s accelerated into a 6-month period. So yeah, there is that possibility if they make that mistake. But I'd be surprised if they did it.
How can you be injecting that much liquidity, the chart that I just showed you, and also be tightening at the same time? It's semantics, right?
Transition.
I mean, that's a dog and pony show. That's completely pretend. And I just want to say, Mike, I know you're about to jump in, but when I hear you guys talk and when I read this news, 2008 was only 15 years ago. We've already broke the banks again. The same effect. Okay, it's a different problem of the same making. How do we ever trust? What are they going to do? What legislation are they going to pass now? What rule are they going to make that's going to fix this besides fully backed banks, which then effectively reduces all of the lending and money in the economy? They can't do that.
Fully collateralized crypto dollars.
I think that
there's a natural solution here, right? Fully collateralized crypto dollars.
But those crypto dollars are backed in these banks. And listen, I'm a huge fan of USDC, but we definitely saw a little wobble, the day after I left. The peg was at 85 cents. That's false, by the way. I want to clarify. The peg of a stable coin is determined by the actual redemptions, not what it's being traded at on an exchange, because people are willing to dump it. But if all of those banks went under and those assets were backed in those banks, and let's not pretend that treasuries, which are safe right now, could not have issues as well if this all goes down, then where are you at?
So USDC publishes publicly what treasury they hold, and only a small portion, I think it was, were actually in banks, most of it in treasuries. And the month that went down, and we proved that, oh my gosh, this technology is pretty amazing. So I just want to point out a little bit about the historical aspects of, I think, what's happening in the U.S. stock market. Just when it peaked with money supply at the end of 22, it was the most expensive ever versus GDP, the most expensive ever versus global equities, and the most expensive ever versus U.S. housing. It's just starting to roll over. So also, let's look at the boomers. What boomer in their 70s is buying? Every one of them got way overweight equities with trying to avoid it, just because markets make you that way and their advisors make it that way. Now, to me, it's changed. They might be buying boomer rocks. Some of them are smart enough to buy some Bitcoins, but to me, that's what you're going to get is a normal 50% correction, and it's part of demographics. Remember, the U.S. stock market was the most expensive ever versus a lot of these measures. So to me, then the key add to that, the ease of easing we saw from the Fed, which really pumped a lot of the rally since the bottom at 666 in 2009, is gone forever. They will not make that mistake ever. Now, they will ease. They have to, but they're not going to throw the liquidity they did. So to me, that's part of that paradigm demographic shift that makes me think longer term, you're better off in staying away from the U.S. equity market for an extended period. It's just normal underweight that's happened in history. I mean, when it peaked in 2000 and it took till 2014 to stay above that level, maybe not that long, but demographics have really shifted. And all this wealth creation, me can lock it up in a 1-year bill and 2-year notes. So to me, that's part of the macro shift. The key thing I want to also point out is I'm not going to pivot too much. Just one thing that's uber deflation, I think potentially is going to happen. We might see within the first few weeks is this pivot from Mr. Z right now. He's visiting Putin. He's got one choice. He completely gut punched his biggest client, Europe, by supporting the war. He completely gut punched the U.S. and he realizes, okay, I'm the one person who can stop the hostilities there. If I do that, now I'm going to be Mr. Statesman, but I'm also going to crush the prices of food, grains. There's still a major war premium there. So that's my suspicion that's going to be hitting the tape soon, that this aggressions will be lightened up, partly because Mr. C said you should, partly because he realized his economy is collapsing and will go down because his biggest export customers are gone. They don't want to do anything business, not right away, but they do not want to touch anything to do with him anymore because, I mean, we remember what happened with the Molotov-Ribbentrop agreement when Germany cozied up the Soviet Union before. Europe's used to this.
Yeah, there's a lot there. I mean, obviously, Putin also making overtures, according to at least one news source, saying, well, there could be a diplomatic solution. I don't think is a coincidence given what you just said, but that's besides the point. I mean, yes, that's deflationary in the sense of commodities, but it's also opens up people's willingness to take risks, because a lot of people believe the geopolitical risk is there. You can get rid of that premium, and that's another good thing for a lot of risk assets. I want to go back to the point about crypto dollars, because I was listening on the way in to Raoul Paul with Pomp yesterday, and he made an incredibly important point, which I kind of knew because I'm old and I remember it, but I kind of forgot. Which is the fact that last time the U.S. regulators got overzealous, thinking that they owned a market, and we ended up losing the market, was the euro dollar market, created by the less regulation in the UK. Sorry to talk about a competing one, Scott, but Raoul was brilliant on this, and he's exactly right. London became the center of the financial universe because of euro dollars. The only reason why we don't worry about that here in the United States, or don't really learn about it or think about it, is because it benefited us, because it made kicking and screaming over the objection of U.S. regulators. It turned the dollar into the global reserve currency, which has massively benefited American standard of living and been disinflationary for years and years and years. And so to argue it, now imagine a new world where Elizabeth Warren wins and Gary Gensler wins, and all of crypto innovation goes to Europe and the UK, and London gets the chance to become the biggest financial center, including owning crypto dollars, maybe. But maybe this time they learn their lesson. It's like, well, how about crypto Bitcoin, and how about crypto euros? And the threat to the US, if we lose financial primacy, when the dollar might not be the reserve currency in the long run, that is very serious. So the US officials should really be thinking about history. To say that it can't happen, it can happen. It has happened. And it happened, and so it's important to understand. So that's the one thing about crypto dollars I wanted to make it clear. To go back to what the fix is, I think the fact of the matter is that the biggest problem that we had here is an accounting system which is so Byzantine and has so many incentives for various reasons that allow people to lose trust. I mean, let us not forget, 2 weeks before Silicon Valley Bank went boom, their auditors gave it a clean bill of health. Why? Yeah. Because their balance sheet was not required to realize losses. We could talk about fractional reserve banking, and we had a great conversation with Caitlin early, kind of the middle of last year, Scott. You might remember it. I really enjoyed it, where I basically said there's benefits to fractional reserve banking, but we need to do it much more intelligently. And she's like, nope, it can never be good. Look, I think I'm right on this one, but I totally agree with her. The fractional reserve banking, when you don't require transparency in the P&L, profit and loss, on the bank's balance sheet, is an effing problem. Because if you had to report unrealized losses within 2 quarters of the Fed starting to tighten, you would have seen, they would have had that data at the Fed of declining bank reserve quality. They would have seen it. And as it stands, they didn't see it. And that's a real problem, right? So, you can't enact policies blind. It's like trying to drive your car looking out the rear view window. I mean,
like the Fed.
it's problematic, and that's what happened. And the other thing that's interesting is there are people out there who are making the statement that, well, this is all crypto's fault, which is the most laughable thing ever. And it's particularly laughable when crypto is showing the solution. The fact is whatever you think about DeFi protocols, whatever you think of the value, and I'm not going to talk about the value of Aave as a token or any of the others, but what I will say is Aave, Maker, etc., have all functioned through a period 2022 where they had to be fully collateralized and actually survived really well. And then the third point, right? It worked. That system works. It's an over collateralized system, but there's collateral on the other side. So there's leverage on the trading by the fact that all the exchanges give leverage and market makers can use that. And the DeFi protocols are fully collateralized and they can work. The last point that I'll make, and this is one that I've said a few times, but it just pisses me off, is what we endured, and I'm sorry to bring this up, at Voyager and at Celsius is literally the same thing that the banks have done. The difference is because it's crypto and because it's small, the society said, let it fail. Well, crypto has experienced a lot of creative destruction, as capitalist fans will tell you. The banking system hasn't yet. But anybody who claims that crypto is the cause, no, it's the other way around. The banking system now is reflecting back into the crypto economy, and that's what's going on. And all the issues, like I still don't know whether Signet's going to be operational, right? They don't know because the quote rescue of Signature Bank was only a partial asset buy, and so we'll see. Anyway, so there's a lot there. I'm sorry for the rant.
No, that's a good rant. I wanted to add a little bit to that, Scott, unless you wanted to guide a little bit on that first.
No, you first, and then I want to talk about Bitcoin. Go ahead.
Because I want to get the Bitcoin right away by starting with GBTC. It's up 100% from last year's low. It's just printing 16 right now. And I look at this asset, and when you mentioned Gary Gensler, Elizabeth Warren, there is litigation right now, and it's likely SEC is going to lose. And that's not my opinion. That's from my colleague Elliot Stein, who's an astute lawyer who writes for Bloomberg Intelligence, and that's just the way it's looking. A good indication is what it's doing. And I look at this asset, I'm like, what stops it from going to 100? I mean, it's clearly heading up. It's at a big discount, and we're seeing what's happening in the macro. So to me, I like to start there as far as indications. And one thing I think it's so important in our society is it's so important to have people like Elizabeth Warren, because that's what's important, to have that discourse and see how bad it can get and how, why am I descendants of a bunch of Irish and Lithuanian peasants who had migrated to Chicago? Because people like that don't understand economies, and to see how the tilt. And to me, this is what's happening is we're saying, okay, well, we don't want to go there. Yes, we're going to fight it out. But I look at it in the macro is, okay, so GBTC looks like it's going to succeed. I don't see how it could get worse, but I have to end on what you said about Eurodollars. Crypto dollars to me are almost the exact same thing 50 years after, it started out really from the Soviet Union and Soviet states trying to get access to the dollars. And I remember this was a key thing that struck me in 2018-19, seeing it happen in Hong Kong. And crypto dollars, and when the New York Attorney General came down on Tether in 2019 and Bitcoin bounced, to me, and right away it came right back. That to me is still the signal that we're doing again right now. We just went through the same thing. We had a pretty significant pushback in crypto dollars. And what did we realize? Wow, this technology is remarkable. We don't have to worry about fractional reserves and crypto dollars. Yes, some of them are dicey, but they'll work those out.
And Tether, since this entire crisis has been outperformed, is traded at a premium to the dollar and a premium to USDC. And so if that isn't a almost proof of a replication of the Eurodollar, where the US lost control of the dollar market to its ultimate benefit, it's the same thing here. And the New York AG, I mean, don't get me started on Tish James and what her priorities are, because they're completely upside down from what her constituents probably want her to do. But that's besides the point. Look, the reality is that there's an inflection point here in the globe. And when it comes to Bitcoin, like you mentioned Hong Kong this weekend, or was it this weekend or late last week, that was the other piece of news you haven't thought about, opened up legally. Citizens can now buy and sell large cap crypto. Now, we know Hong Kong doesn't say boo without Xi saying it's okay. So if you talk about what could drive the next bull run in Bitcoin, well, now we have multiple causes. We have liquidity about to be unleashed into the market. We have people who have lower than ever confidence in the fiat system. We have the sleeping giant of Chinese wealth now legally able to buy it. And this is not remotely surprising. I mean, look, yeah, a few weeks ago I said the 28 to 32 range was baked in the cake, and obviously here we are, into that range now. The truth of the matter is, I would be stunned if Bitcoin doesn't make an all-time high this year, unless the Fed does something totally different than I expect them to do. I literally will be stunned. That doesn't mean it can't go, gyrate wildly and stop out people. Never use leverage, please. And by the way, don't take anything I'm saying as investment advice. This is my opinion, and I want to be the only one who suffers if I'm wrong. But the fact is that the tailwinds are aligning, very strongly. So you want to talk about Bitcoin, Scott?
I do more, but I want to point out one other thing that I sort of just realized. Fidelity quietly opened their Bitcoin and Ethereum, I believe, services to their 40 million customers this week. In the midst of all of this nonsense about crypto and question marks and regulation, Fidelity opened that. And by the way, just like Robinhood, when they first started, you deposit or withdraw crypto into a Fidelity account. So what does that mean? Yeah, that's bad, right? You're shaking your head. But what does that mean? That means there's 40 million people who, if they want to sell Bitcoin, will have to buy it first on Fidelity. The only people who can sell Bitcoin on Fidelity will be ones who have bought it on Fidelity. And how many of those people are actively day trading? So you've effectively opened a buy-only service to 40 million customers in the United States.
Well, those are two, I think, significant bullish fundamental things. Fidelity and Hong Kong. I was really shocked as he pivoted on Hong Kong like that. And I think he's realizing the error of his ways of complete autocratic leadership and realizing that we're really falling behind here. We got to catch up. So
I think he was throwing a bone to his rich people. Because the wealth in China, a lot of people are pretty pissed off at what he's been doing to the wealthy people, and so this is a bone to the rich, I think. But that's besides the point. I mean, I am far from a geopolitical strategist, so right. That seems to be the case. Anyway, sorry.
We've talked about all of this in theory for so long, though, right? So we have this 1 week, right? And I kind of touched on it in the intro. Is the signal or noise? Is Bitcoin going up because people finally lost faith in the system, see what's happening in banking, they're buying it as a hedge? Or, obviously last week everyone was saying that Binance had moved $1 billion and was just buying a bunch of Bitcoin to move the price up. Is this something that's happening with a short squeeze or trading, or are we literally seeing it all really happening now?
I think
that's what I want to get to the bottom of, because I can't really reconcile that personally yet.
I have to admit, I have sometimes always get confuzzled with the trees in the forest. The macro is all the things that a lot of us have spoken about for 5 years or so are all happening. And the last crisis was the birth of Bitcoin. This crisis, I think, is defining its value. And we're watching in slow motion. Like you said, Dave, if it makes a new high this year, I'd be quite impressed, because I still think stock market has a much lower way to go. But it's showing that inflection point that I've been writing about for too long. And now that it's happening, I don't want to be missing, but it's clearly showing pure inflection. The key thing is what stops it. But the key thing, they're trying to narrow down what I have the press ask me all the time. And since I was in the trading business, they'd be asking me, Mike, why is market doing this or doing that this day? And a lot of times now I just say, I don't care, because trying to figure that out will just confuse you, versus the macro is the world is turning to this asset. And I like to think about Fidelity is, okay, what boomer rocks? Yeah, boomers are becoming much more conservative. They should be in fixed income, and fixed income is offering them good returns. What millennial cares about gold? I mean, and they think equities, but they're all involved in cryptos.
Yeah, I mean, look, we just rattled off 3 monstrously large macro things that got unleashed last week. And what a surprise. The market behaved rationally. Between Hong Kong, Fidelity, and the BTFP, which I think that this banking crisis, and look, I said it on a couple of interviews and a couple of things I've said, I've made the point. I think this is the second Genesis event. I called it 2 weeks ago or a week and a half ago when Silvergate, when SVB did it that night. I said, this is the next Genesis event, because they can't let this go. because I knew it. There was no way they could let those depositors go, because they know that there would have been a bank run on every single regional bank. There was literally no way. Now, there's all sorts of politicization. I don't know how you pronounce that word. Politicization. I have to look at it. But people are on one side saying, well, it's because Silicon Valley Bank was woke, they went broke. That's nonsense. They went bad because they had horrible risk management, and they were sort of guided into it by the government. Yes, there are lots of rich people with money in Silicon Valley Bank, but the reality is if you allowed depositors to lose money in this country, we saw how fast people can move money out of banks. The difference is back in It's a Wonderful Life, they had to line up at Bailey's savings and loan. Now, boom, minutes. And so, this is we live in a different world. And so that sort of crisis of confidence couldn't be allowed. So to me, it seemed pretty obvious that we get that wall of liquidity. But Raoul Paul pointed out something else. He said, listen, the last time there was that liquidity, Bitcoin did jam. Yeah, absolutely. But it took a long time, and it's volatile along the way. The path, if I say I think we're going to 100, that doesn't mean we don't see 20 first. Or it doesn't mean that we don't go to 50 and then back down to 30, whatever along the way. It could be very sawtooth, because there's going to be regulatory news. There's going to be people in politics making threats. I saw some, very far out there, prediction this weekend that, well, they were going to outlaw owning gold and Bitcoin again. And you're going to start seeing that FUD going. Now, people don't realize, I want to be clear about this. Why do I make fun of the outlawing gold? The government did the gold ban thing for a very specific reason, to reflate the economy. They confiscated gold at $20 an ounce. And as soon as they owned it all, they revalued it to $33 an ounce, essentially making a huge percentage increase in the money supply and reflating the economy. It's almost like a one-off default, only they put it under cover of night. That's why they did it. That wouldn't help them today. And certainly Bitcoin is not even remotely, it's not even in the same zip code of being large enough to make a difference to the Fed's balance sheet. So, or to the government, GDP. All of Bitcoin taken together isn't enough to matter. Unless they confiscate it all and revalued it up by a factor of 100. Yeah, they could do that. But my guess is that would not be seen as constitutional by anybody, but we'll see. Anyway, that's a couple of historical points there, Scott, for you.
Yes, good stuff.
Yeah, and I agree with all of what you're saying there. I just curious how high this can go. Like, I don't like to make price predictions. I think I'm just still kind of, Mike, you said it, right? You write about this all the time. Then you sit here in shock when it really happens. Yeah, and that's sort of where I'm at.
That's the key thing that I think Dave made very important, and I've lost my hair trying to trade, but made a good living mitigating risk with clients, helping them hedge their risk, like this put spread I initially recommended around 25,000, and that is like Dave mentions about leverage. Now I completely take that to heart, for particularly for retail, but when you're like me, I come from futures, and the typical leverage is 20 to 1. It's how you manage it. And we used to say in the trading pits, oh, he's trading without stops, when it means someone was seriously, or you make sure you use options properly. But yeah, leverage will hurt your typical retail person, but for investors, it's just normal. So I look at it as be careful trading, and like Dave said, he's not going to disagree. It can't get down to 20,000, but responsive. I think responsive investors, and to me, this is the trigger now. Now I fully anticipate your average responsive investor now is going to be looking to buy Bitcoin and dips, and they might be lighting up on rallies. But that to me is, it's really switched. There's a fundamental paradigm shift here in this market because of the crisis.
I mean, don't make any mistake. The fall from 69 down into the 40s was, very few people said, very few people at the time were talking about, okay, we know it was frothy and this is normal, etc. The fall from the 40s down to below 20 was pretty much almost exclusively forced selling from people who didn't want to sell their Bitcoin, but had to because it was the only thing they had, or leverage. So when I say that the first stop is 28 to 32, but that ultimately I see a pretty easy path into the 40s, and then we have to assess what's the fundamentals. I've said that all along. When people want to get back into this market, FOMO gets very, very real when things start to move. look, I don't like making time predictions because I'm almost always wrong on the short run, which is why every place I've been has been, multi-factor hedged. But the fact is that the upside is substantively larger than the downside at this point, unless the Fed does something very different. But if the Fed and the global central banks reliquefy like they have to fix the banks, fixing a double-digit trillion-dollar industry is their priority. Worrying about whether or not a single trillion-dollar industry goes up too much is not on their minds. I mean, yeah, they say it. Even Powell said it yesterday. And this is his typical way. Yeah, I don't want to destroy crypto. And I think we know why. He goes, but it's a mess. Sure, it's a mess. And your banking system, which has literally holes in its balance sheet bigger than the entire market cap of crypto, isn't. I mean, it's kind of crazy to me. But that is the world we live in.
How about the fact that it's 2023 and Powell is talking about crypto and being forced to do so?
Well,
I'm not even sure I would have had that on my bingo card, to be quite frank.
That's true.
It's so much in the mainstream for an asset that's less than $500 billion. It's gonna you're gonna have to multiply by X's in the future. And I think what Dave said is really clear now. This is why the world's different. We will get reliquefaction from central banks. Most one that matters is the Fed, but nowhere near the pace that we've had for the last, certainly since the stock market crash. Remember 1994, that was a pretty serious tightening schedule. You might remember that one, Dave. I remember I was kind of getting up a little exuberant. Yeah, but we're not going to have that reliquefaction like we have in the past because of the lessons of inflation, which will be resonating for our lifetimes when they reliquefied too fast, too much. So to me, that's where the world is going now. And that's why this is a different environment for things that depended on that. U.S. equities, that's over, and it's a recession. So we have to get through this recession. If we don't get it, that's a shock. As of just 2 weeks ago, the probability was the most ever from the yield curve. You can't say that's decline. So we got to get through this recession, I think, to think about anything like risk assets like equity. But look what gold and bonds and Bitcoin are doing. Those to me are going to be some of the things that people are going to be looking to buy on dips as we tilt in the recession.
Yep. And that would be my investment thesis in a nutshell. I think the decoupling that people in Bitcoin have been looking for is upon us. And I think that's the reason why. The interesting question really is, I think that a lot of other crypto assets, once you get beyond Bitcoin, Ether, and maybe a couple of others, and I'm not talking about stable coins, are actually more like stocks in terms of they could get absolutely wrecked. And we've never seen that.
They are. Relative to Bitcoin right now, I mean, this is a normal cycle, right? Of course, when Bitcoin's sort of raging, liquidity leaves all coins into Bitcoin. Bitcoin destroys that market, and then you even out on Bitcoin. Money flows back into alts. But
the problem is that
this might just be a Bitcoin rally because of the fundamentals of Bitcoin.
Well, I mean, there's some fundamentals in DeFi land as well, but the fact is, and
I'm talking about the 10,000 coin tail.
Oh yeah, no, I don't know whether there's 200 or 300, maybe 500 tokens out there that might ultimately have value, or if it's less than 100. What I know is it's not thousands. And until coins like that have no value get completely wrecked in a rally, that's one of the things that always makes me cautious. The tops in Bitcoin tend to be when altcoins get ridiculously frothy. And also the fact that altcoins aren't really doing that much, the correlation among altcoins is way too high. Those are the two things that always spook me. That plus, excess margin leverage and people paying too much in derivatives, none of which is happening now. I mean, right now, this market climbed a wall of worry. There was never really a big liquidation. The long sides are still being more liquidated than the shorts. The shorts haven't gotten squeezed yet. Maybe because there aren't that many. I don't know. I mean, that's hard for me to tell.
What is wrong with Shiba Inu being the 13th largest crypto asset listed on CoinMarketCap? I look at that and remember one thing when I pointed out how silly, stupid, speculative this was in 2021, I wasn't more aggressive about it because that is the stuff I agree with you.
Shiba Inu at that price is just like my favorite story from the internet bubble in the 2000s, Net Taxi. Shiba Inu's value proposition. Every time I pick on them on this show, I get lots of hate mail. So I want to be clear. Their value proposition is they believe they are building a community among themselves that's large enough to be able to merchandise and do stuff, which was the same as most of the internet companies that completely failed. GeoCities and all these, there's so many of them. And
so
that's
I'll take an index.
I'll take an index.
I'll take an index of cryptos, top 20 or 10, let the index decide. But picking out winners, good luck with that one.
That's right.
We only got a couple minutes left. So, Mike, I want to ask you at this point, both of you, is this a choice for the Fed this week between inflation and the banking system?
So
are we now at that point where we're saying we have to let inflation run to save the banks, or can they somehow thread a needle here?
I'll just say that their academic bent will disappoint us again. And this might turn out to, we'll look back at this in the future about abolishing the Fed because they created way too much inflation, did not acknowledge it. And now they're going to create a depression, which is happening. It's just a fact. And they should just say our forward-looking indicators for inflation are they're not falling, they're collapsing. I can point out PPI is going to be negative in July for year over year. It's on an 8-month basis already is. They should just stop tightening, bar none, and let this work out. But I'll read my colleague's comment from Tom Moore, like he's our chief economist, is you're not banking, central bank hawkishness in a banking crisis is an oxymoron. It's inappropriate.
While I agree with the sentiment, I think that he knows he has put $4.4 trillion potentially available to the banks by his new facility. He knows his colleagues are pissed off at him to begin with. And there's a whole story there. You could read Noel about that, how people were upset about the way they handled the banking crisis, but they did that bazooka. I think he feels I just put in the bazooka. I need to stay the course on tightening and do it to, quote, sterilize. I don't think it's correct, but that's what I expect him to do. Now, maybe they'll surprise us. Maybe he'll realize that inflation from measured by consumers is down, and he'll stop obsessing about assets and puncturing the asset wealth bubble to trigger a mild recession, which has been his thought. At this point, with banking stocks doing what they're doing, he's playing with fire and could actually trigger what Mike keeps talking about in the S&P.
I can't believe we're at 10:30, guys. I feel like we should have done 4 or 5 hours of just making up for last week. But the good news is that we get to run it back every single Monday. I'm so cautiously optimistic here. I want to get super excited and believe that everything we've sort of predicted for all of these years is happening with Bitcoin. It's just hard not to. After all the PTSD and all the experiences, it's hard to let myself get there. But I'm on my way. I'm working on it.
It's never that easy. It's nothing ever moves in a straight line, but the trend is there. So we won't know if this conversation we've been right for 6 months to a year, but the trend is really what we're focused on. What Mike thinks should be done by the Fed, and what I think will ultimately happen. But just it is what it is.
Well, I'd like to invite both you guys tomorrow, if you can make it, 11 a.m. Since I don't do YouTube on Tuesdays now, I have another Twitter Spaces, but I haven't really let the cat out of the bag. But I've got Saylor. Mike, I know that you have spoken with him. I watched you do it on Bloomberg, and it looks like this is, I'm allowed to say as an unconfirmed guess, it looks like Balaji will be there as well. Who just obviously made the $1 million bet that Bitcoin will be worth $1 million in 90 days. So I don't know, putting him and Saylor in a room at the very least, I think you guys should maybe just show up and sit on stage with me.
I mean, I've never hoped somebody wins an outlandish bet more, but but I'm not really happy with what that would signal.
Oh, and Jimmy Song is going to be there as well, already confirmed. There's going to be a Bitcoin conversation for anyone who is curious, but that will be at 11 Eastern Standard Time tomorrow. Now, I can't guarantee that you guys will get to speak, because we all know that if you ask Saylor one question 3 hours later, there you are. And it's, it's like listening to a prophet, but I would love if you guys would join. So guys, that's all I've got. Tomorrow, of course, I will not be on YouTube because I will be prepping for this Monster Spaces, which I'm really, really excited about. So I can't wait to do that. Guys, I hope you can join. Everyone, Mike, Dave, thank you so much. As usual, everybody go follow them, please. For God's sakes, already do it. That's all I got. See you guys tomorrow on Spaces.
Cheers.
Thanks.
That's dope.